This is the tax platform informing the nation on tax matters. Welcome to the first episode of 2024. And like we promised previously, of course, after a million times, we are now available on visuals and we've since joined TikTok. Our YouTube episodes have also been audio. Now you'll be able to see the person behind the mic. Now, our episode starts off with significant personal income tax amendments that were made to the Income Tax Act. These are specifically to do with terminal benefits. These are things like your severance, gratuity, pension, or retrenchment packages. You will remember that in the year 2022, the Retirement Funds Act was amended, and among other things that were amended in the act was to move the threshold of getting pension at 1/3 to getting a lump sum of 50%. And another significant amendment to that act was in relation to paying out hospital bills or loans from your pension funds that are deferred. Now, whatever amendment that was made to Retirement Funds Act, especially in relation to the portion that you take as a lump sum, these were now aligned to the income tax exemptions, which are found in the schedule to the Act. And one of those exemptions in the Income Tax Act was in relation to pension. So we'll know that in the past, whenever you drew a lump sum, you will draw 1/3 and that 1/3 will be exempt. Now that the threshold in the Retirement Funds Act has been moved to 50%, it has also been adjusted to 50% in the Income Tax Act, such that the taxpayers can benefit from whatever they are getting, and then they can pay tax on the rest of 50% that will take monthly or whatever arrangement that they would have made with their pension fund administrator. Now, when it comes to pension, the Retirement Funds Act was amended such that you can pay your loans or you can pay your hospital bills with whatever you have drawn from the pension fund that is deferred when you do an application. So that has also been exempt from tax, but it can only be exempt if 100% of what you are drawing goes to medical bills. So instead of paying you, it will go straight to whatever hospital that is attending you. And the same applies when it comes to loan. If you are drawing an amount to clear out a loan, initially the 50% of that amount that you are drawing out will be exempt. But if it is discovered that whatever amount that you are drawing, you are going to fully apply it to that loan, then 100% of it will be exempt. Of course, you'll have to prove that indeed the amount that you are paying will go to the loan, and the loan is equal to that amount that you have withdrawn, or the loan is more than the amount that you have drawn. For instance, if you are owing a certain bank A, 300,000, and you have about 250,000 in your deferred pension, if you withdraw that 250,000 and pay it to bank A, there won't be any tax implications on that 250,000. But if you have 400,000 and you want to draw 350,000, the 50,000 that is excess of the 300,000, you will have to pay tax on that, but only the 300,000 will be exempt. In the next episode, we will move to things like retrenchment package, severance, and gratuity on when you will be able to be exempt from tax. Hope you enjoyed the episode and it was informative. Remember, we are available across all your favorite streaming platforms. We're available on Spotify, Apple Podcast, and now, of course, on TikTok and YouTube through visuals. Thank you and have a